Welcome to vTalkInsight, Market Drivers Daily for December 2, 2025. Markets are entering December with rate cut expectations near extremes, an AI boom that is both powering growth and testing valuations, and a geopolitical backdrop that keeps risk premia elevated. Let us begin with how the evolving monetary easing story is steering global assets. Across rates markets, the dominant narrative is that the Federal Reserve is about to move, and move soon. Futures are effectively fully pricing a rate cut at the next meeting, with implied probabilities close to certainty after rising from roughly one quarter just weeks ago. Compared with last week, when conviction was already high, this marks an even stronger embrace of a December cut, and that shift is now embedded in everything from yields and metals to FX. Overlaying this, the question of who will lead the Fed next is adding another layer of volatility. Speculation that Kevin Hassett could be nominated as the next chair has pushed markets to price not only a near-term cut, but also a somewhat easier path further out, with some estimates suggesting policy rates could end up around 75 basis points lower than otherwise. Hints of a more dovish leadership have already pulled 10-year Treasury yields below 4% at times, even as confirmation of any new chair is unlikely before January, delaying clarity on the medium-term strategy. There is a growing gap between market pricing and some fundamental readings of the economy. Inflation is still hovering near 3% and unemployment around 4.5%, while recent labor data do not yet show clear deterioration. Some forecasters, including large banks, see multiple cuts next year and still project U.S. growth of around 2.4%, whereas others argue the Fed may deliver only one or two moves because inflation remains above target and the political tolerance for aggressive easing is limited. The risk management angle is central here because official statistics have been delayed, leaving policymakers with less fresh data than usual going into this meeting. That increases the odds of a preemptive cut, but also raises concern that easing without clear economic weakness could be viewed as a policy mistake. Commentators warn that cutting into relatively firm data risks reigniting inflation, steepening the yield curve as long-term expectations rise, and ultimately undermining the very affordability gains that lower policy rates are meant to deliver. The repricing toward easier U.S. policy is rippling through other asset classes. Expectations of Fed cuts above 85% have weakened the U.S. dollar and supported the euro, even as some longer-term views still see only limited dollar downside because European and U.S. policy are expected to converge. In contrast, the British pound faces medium-term pressure as markets anticipate the Bank of England could end up cutting more than is currently priced, against a backdrop of political uncertainty. Precious metals, particularly silver, have surged on this backdrop, aided by tight supply and tariff-related frictions, while crypto assets have sold off as part of a broader risk-off tone. Equities are heavily exposed to how this plays out because current prices already assume roughly 75 to 100 basis points of cuts over the coming year. If the Fed ultimately delivers less than that, or if leadership changes fail to materialize in the dovish direction markets now expect, the dollar could rebound and risk assets may need to reprice. At the same time, a cut driven by labor market weakness rather than improving inflation would be a negative signal for credit, whereas an easing justified by better price dynamics would be far more benign. With a structurally smaller labor force and a K-shaped U.S. economy, the stakes around this meeting, the chair nomination, and the Fed's messaging are unusually high, setting the stage for our next topic, whether AI-driven growth can continue to offset cyclical and policy uncertainty. Artificial intelligence remains the dominant macro growth story and a central pillar of equity sentiment. AI-driven activity is widely seen as offsetting broader economic softness, to the point where some argue that without this sector's momentum the economy would be flirting with stagnation. At the same time, concerns around valuations, leverage, and concentration have intensified, making the AI trade both a powerful engine and a potential point of fragility for markets. On the infrastructure side, there is a structural shift underway from traditional CPU-based computing toward GPU-accelerated architectures. Hyperscalers are committing very high levels of capital expenditure to AI and data centers, and demand looks real rather than speculative, with reports of waiting lists for capacity. Nvidia still commands close to 90% of the GPU market and remains supply constrained with strong margins, while it deepens its ecosystem through a $2 billion stake in Synopsys and strategic investments in partners such as Intel and Nokia to lock in customers and extend its reach. Beyond infrastructure, adoption across the real economy is accelerating. Around 45% of companies are already implementing AI solutions, generating estimated cost savings of $130 billion and underpinning positive earnings revisions into 2026. Economy-wide, AI-powered automation is estimated to be capable of handling more than half of all U.S. work hours and could unlock roughly $3 trillion of value by 2030, spanning industrial robotics, scientific research, digital biology, and consumer applications. In retail, U.S. web visits coming from AI platforms have surged more than 800%, delivering higher conversion rates and changing how brands think about digital marketing and search. Yet there is an important timing mismatch between market performance and fundamental productivity. Near-term equity gains look more like a wealth effect driven by rising AI valuations than by realized efficiency improvements, because actual workplace automation is lagging. Barriers such as retraining costs, organizational culture, and implementation complexity are slowing rollout, which moderates the immediate impact on labor markets even as long-term displacement debates gather pace in legislatures. Over time, AI is still expected to exert significant deflationary pressure by lowering costs in sectors like healthcare and services, but investors are grappling with how long that journey takes. This backdrop has produced a more selective equity market. AI-related trades are shifting toward companies with vertical integration and diversified revenues, and away from pure hype stories, even as overall valuations in the space exhibit classic bubble traits such as circular financing between vendors, aggressive capital spending, and heavy index concentration. Recent weakness in the so-called mega-cap complex, with all of the large tech leaders in the red on some sessions, highlights how quickly leadership can rotate and how vulnerable benchmarks are to a 10 to 15% correction if AI enthusiasm cools. These concerns now rank as the top perceived risk for many investors, even ahead of central bank policy. The AI build-out is also reshaping credit markets. Tech companies are driving a record wave of debt issuance to finance data center expansion and AI investment, with projections of up to $1.5 trillion in new tech debt by 2028. Investment-grade borrowers tied to AI generally retain strong balance sheets, but spreads are widening for lower-quality credits without hyperscaler backing, and investors are openly skeptical about weaker private credit exposures linked to the theme. The macro regime matters here as well, because an AI-driven equity bubble bursting could push the Fed into further rate cuts, and history suggests that such cutting cycles often coincide with negative equity returns. Despite these risks, the long-term AI narrative remains strongly constructive in many outlooks. Some houses project the S&P 500 reaching 7,000 by year-end and 7,500 by 2026 on the back of broad AI adoption, with expectations that the AI-related tech sector could gain at least 20% over the coming year. AI investment is framed as both a powerful economic driver and a deflationary force that could support risk assets and credit markets, even if upside from here is more measured. For now, markets are highly sensitive to news on enterprise adoption, data center utilization, and regulation around AI supply chains, all of which will interact with the monetary easing story and, as we turn to next, with an increasingly complex geopolitical environment. Geopolitical developments continue to inject uncertainty into markets, even when price action occasionally suggests complacency. From Ukraine to Venezuela and crypto regulation, the common thread is a persistent risk premium that ebbs and flows with headlines but never fully disappears. This is shaping sentiment in European equities, energy and metals, emerging markets, and even digital assets. The Russia-Ukraine conflict remains the central geopolitical focus for Europe. US-led negotiations with Ukraine and Russia have made incremental progress but no clear breakthrough, and a series of high-level meetings scheduled this week comes against a backdrop of deadlock over territory, NATO membership, frozen Russian assets, and security guarantees. Some reporting suggests that frameworks under discussion could tilt more favorably toward Russia, which is already prompting political resistance in Europe and reinforcing perceptions that European influence over the process has diminished. Financing Ukraine's future is emerging as a major fault line. Europe faces an estimated €140 billion funding gap for 2026 and 2027, and efforts to tap frozen Russian assets of a similar scale have stalled as Belgium and others resist using these funds for reparations or loans. European policymakers are wary that territorial concessions could set a dangerous precedent for the entire post-war security order, while sanctions on Russian oil are squeezing Moscow and turning sanctions relief into a bargaining chip, even as Europe remains reluctant to ease pressure. Markets are responding in nuanced ways. European defense stocks such as Rheinmetall and BAE Systems have underperformed despite New Deal announcements, and shares have fallen on reports of progress in peace talks, reflecting fears of slower traditional weapons demand. At the same time, there is talk of rotation within the sector toward electronic warfare, cybersecurity, and air defense firms, consistent with a longer-term shift in European rearmament priorities. Oil markets illustrate a similar tension. OPEC Plus has paused production hikes for the first quarter of 2026 due to oversupply concerns, yet prices remain resilient because of risks in the Black Sea and Venezuela, including attacks on infrastructure and uncertainty around U.S. policy. Beyond Europe, other geopolitical flashpoints are influencing risk assets. In Latin America, escalating U.S.-Venezuela tensions, including recent airstrikes and mixed messages from Washington, are unsettling regional markets and raising questions even within parts of the U.S. political establishment. U.S. policy in the region is increasingly shaped by concerns over Chinese and Russian influence, which could affect future investment flows. Meanwhile, Chinese regulatory pressure on cryptocurrencies has triggered sharp declines in Bitcoin and crypto-related equities such as Coinbase and MicroStrategy, underscoring the sector's vulnerability to policy moves and adding to the broader risk-off tone. Looking ahead, markets face a spectrum of geopolitical scenarios, from a frozen conflict in Ukraine that locks in elevated defense spending and sanctions, to a fragile peace that might shift spending toward advanced defense technologies and reduce energy risk premia over time. Ukraine's ability to attract reconstruction capital will hinge on credible security guarantees, a clear path toward European Union membership, and eventual access to frozen Russian assets. Without these, the growth outlook stays weak and Europe's security burden rises. Key watch points now include the next round of high-level Ukraine-related meetings, decisions on the use of Russian assets, any adjustment to sanctions, U.S. actions in Venezuela, and European responses to potential Chinese export surges into the region. Together with the monetary and AI themes, these geopolitical currents will continue to shape cross-asset volatility into year-end. Across today's themes, a common thread emerges: markets are leaning heavily on a dovish Fed path, sustained AI-driven growth, and a manageable geopolitical backdrop, but each pillar carries meaningful two-way risk. Rate cuts are all but priced in, yet the economic justification is contested. AI remains a powerful but leveraged engine of returns, and geopolitical negotiations from Ukraine to Venezuela could still surprise in either direction. Monitoring how these three forces interact across yields, credit spreads, sector leadership, and regional risk premia will be critical for understanding the distribution of outcomes into year-end. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.